PayPal or Block? Which is the better growth stock to buy for 2024 and beyond? That's the question I'm going to answer in this video, looking at each of these two companies, comparing their revenue, their cash flow, their profit margin, their valuation, and looking at their prospects for the next 2 years to ultimately come to the conclusion of which one I think is the better stock to buy for 2024. So you're not going to want to miss this one. Let's jump in, follow with me, let's see the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so let's start with revenue, comparing Block and PayPal for the last 10 years. And you can see they've both done a good job increasing their revenue. PayPal from about 8 billion all the way up to 29 billion. Block from less than 2 billion all the way up to 20 billion in a phenomenal rate of growth. Although I will say for Block, it's a little bit misleading to look at revenue because of the way they account for purchases and sales of Bitcoin. They account for that as a revenue, but in reality, it's not really revenue because customers are buying Bitcoin and then selling Bitcoin, and what is actually revenue is the difference between those two. So it's a little bit misleading to look at Block in terms of revenue, but I'm trying to put these two on similar footing. So let's go ahead and take a look at this metric, but we're going to need more metrics to come to a more comprehensive conclusion. Revenue alone would not be enough to compare these two stocks. So that's why I'm going to look at this next thing, which is cash flow from operations to sales. I want you to take a look at a better explanation of cash flow from operations in this short clip. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. So now that you have an understanding of cash flow from operations and how vital it is to a business, you can see PayPal is ahead of Block in terms of this metric at 13.11% compared to 4.54% for Block. And I will say the trend doesn't look good for either of these two companies. PayPal has been on a downward trend in their cash flow from operations to sales, while Block has been relatively flat. Despite each of these two companies growing revenue, their cash flow from operations is not growing along with their percentage of cash flow from operations is not growing along with revenue, although they are still growing cash flow from operations. Just the percentage is not growing as quickly as revenue is growing. If I had to give the advantage in these two metrics, PayPal would clearly be the winner, more than 2 times better than Block in this metric. The next thing I wanted to look at is the operating profit margin. And again, PayPal is well ahead of Block here with 16.47 operating profit margin. Although this margin has been flat, if you look back the last decade, it, roughly the same place it was at 10 years ago. Block, meanwhile, has been increasing this metric from negative 13% all the way up to negative 1.32%. Although in the last year and a half, this trend does not look good. It's been more downward trending than upward trending. But longer term, the last decade, it has been upward trending. Still, PayPal well ahead in terms of the absolute number of operating profit margin. Now let's look at the prospects for the next 2 years. According to Wall Street analysts, they think PayPal's revenue will grow by 8.2% in 2024, and then it will grow by another 8.7% in 2025. They think its earnings per share will grow by 10.9% in 2024 and another 11.2% in 2025. Solid growth from PayPal. To be sure, it's not explosive, it's not remarkable, it's solid. Meanwhile, for Square, investors think its revenue will grow by 13% in 2024 and another 12.6% in 2025, while its earnings per share will grow by 57% in 2024 and another 34% in 2025. That is explosive earnings per share growth for Square, but remember, or Block, I should say, remember they were well behind PayPal in profitability. Their operating profit margin was negative for the trailing 12-month period that we looked at. So it's understandable that its rate of growth for earnings will grow faster than that of PayPal. Finally, I wanted to compare these two stocks on valuation, and according to the forward price to earnings ratio, Square or Block is trading at a forward PE of 16.11 compared to 10.27 for PayPal. So Block is about 60% more expensive than PayPal. And given the history of operating profitability ahead of Block and cash flow from operations ahead of Block, if I had to pick one of these two to buy for 2024 and beyond, I would pick PayPal. I will acknowledge Block is growing nicely with excellent prospects ahead. I do have Block also rated as a buy. However, PayPal, I think, is better value for long-term investors than Block at current valuations. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.